Jeff Fine, hello.
Good morning.
It's a pleasure to have you on BiTV. You are the global head of real estate client solutions within Goldman Sachs Asset Management. And Goldman Sachs Private Markets consulted over 200 investors and management firms for a study which highlighted their optimisms towards unlisted strategies. What explains this renewed enthusiasm?
Well, thank you for having me on the program today. Delighted to be here. We think it's really important to interact with our clients on a frequent basis to understand the psychology of the market, both to deliver from an investment standpoint that which the client base wants, but also it gives us a good sense for the capital markets and where we see capital moving, because obviously liquidity is critically important to making markets in any sector in which we invest. I think the move toward unlisted or private markets is something that we've observed for quite some time, which was this secular shift in capital from listed strategies to unlisted strategies. The firm was pretty clear about its ambitions to grow in alternatives in particular. And part of that was in response to this big growth trend that we saw, where capital desired more private markets opportunities, and for reasons that we can get more into, and making those opportunities available to a broader audience, a broader universe, is something that's been a high priority. Our projections show a greater allocation of our own capital and clients' capital to alternatives going forward. That's not to say listed companies are bad. It's just to say there is growing interest in what private markets have to offer. I think in the current environment, the prevailing view is that the secondaries type offerings or co-investment type offerings that investors can access through global sophisticated managers are really unique and interesting. We're going through disruptive times right now in the capital markets. We've seen rates on a rapid rise across the world in the face of inflation that is unprecedented in modern times. And investors are excited for the opportunity that that's going to create. It's obviously causing problems in certain pockets of the market, and we can talk more about that later this morning. But I think the general view is private investors will have an opportunity to access some of those unique liquidity-driven opportunities in a way that the public markets might not have the same opportunity to access.
Okay. And among the unlisted investment strategies, how does real estate compare to its counterparts in terms of investor sentiments?
Real estate is being thought of differently in different parts of the world right now. The supply-demand fundamentals in our space vary quite a bit from region to region and even from city to city. There's a lot of sector dispersion that we're seeing right now. There are certain sectors in real estate that have continued to operate and perform very well, and others that have been more challenged. And even across sectors, it varies quite a bit based on region and also vintage of asset. We've seen, in the last couple of years, a real separation between new assets and older assets. Mm-hmm. So I think investors are trying to understand what all of that means. And in the context of, again, the rapid rise in interest rates, which has a direct impact on asset valuations, I think people are waiting for great opportunity in real estate to present as values correct, to create new entry points. And then from there to understand supply-demand fundamentals, to understand how revenues are going to grow going forward. And there are going to be very, very different outcomes. And if you are invested in the best markets and the best assets in the right sectors and can achieve a new entry point from which to grow and take advantage of long-term demand trends, then those are going to be really interesting, great investments. This will turn out to be a great vintage for real estate investments. And I think most LPs understand that. But then there's a whole bunch of stuff that you're not going to want to buy. Assets that, even if they reprice meaningfully, aren't going to have the same growth trajectory. And so investors are rightly being cautious as it relates to those types of assets. The one place we do see LPs getting very, very excited at the moment is in real estate credit, because our capital markets globally have seized up to such an extent in the US with our regional banking crisis, with the bond markets globally being at a fraction of the production that they had in a peak year like 2021. And with this huge wall of real estate debt maturities looming, where we have almost $1.5 trillion of debt coming due over the next 18 months, all of that comes together in a way where the supply demand fundamentals are really favorable to real estate lenders. So the ability to lend, to generate very high current yields from a portfolio allocation perspective, where people have seen yields compress in their owned real estate portfolios, real estate credit becomes a nice supplement to that.
Okay. And what are the main priorities of these investors and management firms you consulted for this new economic cycle that is beginning?
I think first and foremost, people are still managing and working through existing portfolio allocations. So they want to understand what they own. They want to make sure that it's properly marked. They want to make sure that there's a plan for the underlying assets going forward, in the case of real estate in particular. And they want to make sure that they feel in control of those existing allocations, because for many, it's a very large allocation of their overall portfolio concentration. However, that being said, I do think there's been a bit of a turn, in the sense that people were looking quite inward for a long time. You know, we talked a lot about the denominator effect and the difficult capital raising environment in real estate. I think what we're starting to see are some green shoots of investors saying, I do have capital to deploy. I just need to be really selective about where I put it to work. I'm not going to put it to work everywhere. I don't believe in a broad cyclical recovery. I'm not sure we've quite bottomed yet. You know, I think the real estate markets globally still have a lot of stuff to work through, right? The debt wall that we talked about, operational challenges, capital plans that need to be implemented, and completion of projects. When we think about new deliveries, there are a lot of projects that are delivering in 2023 and early into 2024 that need to be seen through fruition to a lot of investors who invested in development, which was such an important part of the real estate business over the last decade. But interestingly, as we look out to later 2024 and into 2025, we see that delivery pipeline starting to slow, which is usually a good thing for real estate owners, because it allows you to have more control over rent as long as you're in a supply-demand balanced market. So it's a really interesting time. I think our consensus view is it's still early. There are going to be a lot of interesting things on the real estate equity side to come as the market deleverages and valuations ultimately start to reset, catalyzed by debt maturities. But in the meantime, the credit, the lending opportunity is so robust that it's creating an interesting way to invest, to generate higher than base rate or risk-free rate yields. And teams are busy. Everybody's excited, and LPs seem to understand that trade in the market right now.
Okay. Well, thanks a lot for this viewpoint, Jeff Fine. And thank you for our viewers.
Thank you. Nice to see you.